rare private letter ruling, the service addressed the application of Section 367A to a public outbound tax-free reorganization. Now, here to talk with me about the ruling is Eugene Kim. Eugene, Section 367A generally makes an otherwise tax-free transaction taxable when the transaction involves a transfer of property to a foreign corporation, correct?
Yes, but there are exceptions. And in order to meet those exceptions, there are a number of requirements. However, relevant to us is the active trader business test. And within the active trader business test is the substantiality requirement. Now, even if you can't meet the test, you can always go into the service for a ruling so long as you're in substantial compliance with the rules.
Doesn't that suggest that the taxpayer in the ruling was unable to comply with the substantiality requirement?
That's correct. In order to meet the substantiality requirement, foreign acquiring's fair market value must be equal to or exceed that of U.S. targets at the time of closing. The rules also have anti-stuffing and anti-stripping provisions that will add in or take out value when measuring substantiality. Here, we had a publicly traded foreign acquiring corporation whose stock, being publicly traded, was subject to market ups and downs. Further, we had a U.S. target that engaged in an anti-stripping transaction. Now, at the time the merger agreements were entered into, even taking into account U.S. target's stripping transaction, foreign acquiring's fair market value exceeded that of U.S. targets. But as we got closer to the closing date, which is the moment in time when we measure substantiality, the publicly traded value of U.S. foreign acquiring stock had fell, and there was a concern that U.S. target's fair market value might equal that or exceed that of foreign acquiring's.
And how did the service rule in this case?
Well, so long as the taxpayer files a gain recognition agreement, the service ruled that the exception would be met. We can see that the service was taking into account the fact that when the relevant agreements were entered into, the taxpayers were in substantial compliance with the rules, and taking into account the fact that we had a publicly traded foreign acquiring corporation whose stock value fluctuated. Jacob, this is in line with what we've seen in the past. However, this is the first time the service has ruled on an anti-stripping provision whose rules are relatively new.
Very informative. Now, the other interesting aspect of this ruling is the form of the transaction. Here, the taxpayer executed a two-step forward triangular merger. Now, Eugene, we normally see these used as an insurance policy in case the overall transaction fails to qualify as a tax-free reorganization.
Correct. Here, we had a U.S. parent that owned U.S. Target, and U.S. Target was a member of Parent's Consolidated Group. On the other side, we had foreign acquiring that set up two merger subsidiaries, Merger Sub 1 and Merger Sub 2, to facilitate the transaction. The first step of the transaction involved the merger of Merger Sub 1 into U.S. Target, with U.S. Target surviving. At the end of that step, foreign acquiring wholly held both U.S. Target and Merger Sub 2. Immediately thereafter, as part of one integrated plan, U.S. Target was merged into Merger Sub 2, with Merger Sub 2 surviving.
So, because the transactions occurred pursuant to an integrated plan, the step transaction doctrine applies to collapse the steps to analyze the substance of the transaction. Here, the substance of the transaction is a merger of U.S. Target into Merger Sub 2. Now, this is viewed for tax purposes as if U.S. Target transferred its assets to Merger Sub 2 in exchange for foreign acquiring shares. U.S. Target then liquidates, distributing the foreign acquiring shares to U.S. Parent in exchange for U.S. Parent's U.S. Target shares. Now, this looks like a tax-free reorganization. Now, Eugene, what would have happened had the transaction, for any reason, failed to qualify as a tax-free reorganization?
Well, Jacob, then this transaction starts looking like a taxable stock acquisition as a result of that first step. Because U.S. Target survives the initial step, we would treat that step as a taxable stock exchange of U.S. target stock for foreign acquiring stock. In isolation, that looks like a qualified stock purchase, and a qualified stock purchase would limit the application of the step transaction doctrine, ultimately meaning we would have to look at the two steps separately rather than as an integrated whole. And so we would expect the second transaction to qualify as a tax-free reorganization, even if the entire transaction did not.
Now, if the transaction was unable to qualify as a tax-free reorganization, what would have happened if the taxpayer had not executed that first step?
Well, Jacob, if the taxpayer had not executed that initial step and the reorganization failed to meet tax-free status, the parties would have exposed themselves to two layers of taxation. Once upon the transfer of U.S. target assets, and then upon the exchange of U.S. target stock for foreign acquiring stock. And to nail the point home, because the taxpayers here engaged in this two-step form, they were able to mitigate any of their risk exposure in the event the reorganization went bad to one layer of tax.
So the first step was a safety net protecting the overall transaction from two layers of taxation in the event the transactions were not able to qualify together as a tax-free reorganization. Very insightful. Thank you, Eugene. For additional information on this ruling and this month's other guidance, please refer to the newsletter or contact your local PwC professional or any member of the M&A team.